Friends, thank you for being here today. What if I told you that a foreign government just locked one of North America's largest banks in a cage and the world barely noticed? What if I told you that this wasn't about justice, but about power? What if I told you that the invisible architecture holding the Canadian banking system together just cracked and the fracture line runs straight through your wallet? Let me give you a number: $18.3 trillion. That's not the US national debt. That's not even close to the global derivatives market. That is the amount of transaction activity that TD Bank, Canada's second largest financial institution, failed to monitor over 6 years. $18.3 trillion flowing through their system like water through a broken dam, and they had their eyes closed. To put that in perspective, that's nearly equal to the entire GDP of the United States, the entire American economy washing through one bank's pipes, completely unwatched. But here's what the headlines won't tell you. The $3 billion fine everyone talked about, that was theater. That was the magician's flourish, while the real trick happened in your peripheral vision. The real weapon, the one that changes everything, was something called an asset cap. $434 billion. That's the ceiling. That's the number TD Bank cannot exceed. They are a bank that has been legally forbidden from growing. And friends, a bank that cannot grow is not a bank. It's a tomb with a green light in the window. This is not a market correction. This is not regulatory oversight. This is the United States government demonstrating that when you operate in US dollars, you don't operate in a Canadian bank or a European bank or a Japanese bank. You operate in an American vassal. And what happened to TD Bank in October 2024, with the fallout still cascading through 2025, is a preview of the structural realignment coming for every institution that thought sovereignty meant something in a dollar-dominated world. This is a mathematical endgame, and the math doesn't care about your feelings. Now let me take you back, not to last year, not to the headlines, but to the origin point. Because to understand why TD Bank is dying in slow motion, you need to understand the architecture of modern banking itself. And that architecture has a birthday, 1694, the Bank of England, the first central bank, the first institution to discover that you could create money not by digging it out of the ground, but by lending it into existence. Debt became the foundation, the bond became the scaffolding, and for 3 centuries that scaffolding held. But scaffolding only works if everyone believes it will hold. The moment doubt enters the system, the moment someone pulls too hard on one beam, the entire structure begins to shudder. And friends, TD Bank just had their beam pulled out from under them, not by a rival bank, not by a market crash, but by a 67-year-old Chinese man carrying trash bags full of cash into a Queens branch, buying gift cards for the tellers. His name was Da Ying-se. The media called him Uncle David. And Uncle David didn't need sophisticated encryption or dark web cryptocurrency. He didn't need offshore shell companies or Panamanian law firms. He needed $57,000 in gift cards and a banking system so drunk on growth that it forgot to look at what was growing. Here's how simple it was. Uncle David would walk into TD branches, sometimes multiple times per week, with literal garbage bags containing up to $1 million in cash, not checks, not wire transfers, physical paper currency that smelled like the streets. And the tellers would count it, process it, and send it upstream. When one teller finally raised a concern to their manager, asking if maybe, just maybe, this was suspicious, the manager said, and I quote, "You guys really need to stop. They are 100% legit." 100% legit. A man with trash bags full of millions, and the institutional response was to tell the questioner to shut up. Over the course of his operation, Uncle David washed $470 million in fentanyl profits through TD Bank, not over decades, over a handful of years. And he wasn't even particularly sophisticated. He was just patient because the system wasn't designed to catch him. It was designed to grow. Now, let me explain what should have happened versus what did happen. In the normal world, the world where banks follow the rules, there's something called a suspicious activity report, an SAR. When a transaction looks wrong, smells wrong, or breaks the pattern, the bank files an SAR with the federal government. It's not optional, it's the law. It's the trade off banks make for the privilege of operating in the US financial system. You get to play with dollars, but you have to be the first line of defense against the money launderers, the drug cartels, the terror financiers. Here's TD's record. From 2018 to 2024, they allowed 92% of their total transaction volume to go completely unmonitored. 92%. Imagine a nuclear power plant that only monitors 8% of its reactor core. Imagine an air traffic control system that only watches 8% of the sky. That's what TD Bank did with $18 trillion. But here's the question you should be asking. Why? Why would a major international bank, one that advertises itself as America's most convenient bank, willfully blind itself to this level of risk? And the answer, friends, is the answer to almost everything in modern finance: growth. The machine must grow, the stock price must rise, the quarterly earnings must beat expectations, and monitoring transactions costs money. Compliance officers cost money. Saying no to deposits costs money. So they didn't. They said yes to everything, built a highway with no speed limit, and let Uncle David and hundreds like him drive through at 200 miles per hour. The US Department of Justice didn't just fine them. They declared TD Bank a criminal enterprise. They forced the bank to plead guilty to conspiracy to commit money laundering. TD became the first bank in US history to receive that specific charge. Not Wells Fargo during the fake account scandal, not HSBC during the cartel money laundering revelations. TD Bank, the polite Canadian institution with the green logo, became financial criminal number one. And here's where it gets architectural. Here's where the foundation cracks. The Canadian regulators, FinTrack, their version of FinCEN, fined TD $9 million. $9 million, a rounding error. A slap on the wrist so gentle it might as well have been a pat on the back. But the United States, the US Department of Justice, fined them $3 billion, 300 times the Canadian penalty, and then they added the asset cap. This leads us to the system's most crucial secret, which we'll explore in depth. But let me plant the seed now. Sovereignty is a fiction when your currency isn't. If you operate in US dollars, you operate under US rules, no matter what flag flies over your headquarters. The TD Bank case isn't about one corrupt bank. It's about the United States demonstrating clearly, violently, that the dollar is not just a currency, it's a weapon. And they just fired a warning shot across the bow of every foreign bank that thought they were playing in international waters. Now, let me explain the mechanism of the cage, the asset cap, because this is where the story stops being about crime and starts being about control. An asset cap is exactly what it sounds like, a hard ceiling on how large a bank's balance sheet can grow. TD Bank is capped at $434 billion. That was their size when the penalty was imposed. They cannot exceed it, not by a dollar, not by a cent. Think of it like this. Imagine you're a builder and you've spent your entire career constructing skyscrapers. You're good at it. It's profitable. It's what you do. And then one day the city tells you you can keep building, but you can never build anything taller than the last building you finished. You're not shut down. You're not bankrupt. You're just frozen, stuck at your current height forever, watching your competitors build higher and higher while you sit in place. That's what the US government did to TD Bank, And here's the perverse elegance of it: banks are growth machines. Their entire business model depends on expanding their loan portfolio, attracting more deposits, entering new markets. A bank that cannot grow is a bank that is slowly dying because inflation alone erodes the real value of a fixed asset base. TD is now a melting ice cube, and the only question is how long it takes to puddle. But it gets worse. To stay under the cap, to avoid violating the US order, TD has had to start shrinking. In 2025 alone, they dumped $48 billion in assets. They sold off loans. They closed branches. They canceled their expansion into the US Southeast, a plan that would have added 150 new locations and challenged the dominance of Bank of America and JP Morgan in that region. All of that gone, vaporized. Not because the market crashed, but because the US government said, "You're done growing." And here's the detail that should make your blood run cold. The US government installed what's called an independent monitor inside TD Bank. This person doesn't report to the CEO in Toronto. They don't report to the board of directors. They report to Washington. They have access to everything, every transaction, every executive meeting, every strategic plan. The United States government now sits inside the decision-making apparatus of Canada's second largest bank, watching, reporting, controlling. Let me ask you a question. If a foreign government placed an unelected official inside one of America's top 10 banks with the power to veto decisions and report back to a foreign capital, what would we call that? We'd call it a coup. We'd call it an invasion. We'd call it an act of war. But when the United States does it to a Canadian bank, we call it regulatory oversight. We call it compliance. We call it justice. Friends, I want you to understand something. The money you think is safe in a bank, any bank, is only as safe as that bank's relationship with the US government. Because every major bank in the Western world operates in dollars. They clear transactions through New York. They hold reserves with the Federal Reserve. They live and die by access to the dollar system. And the TD Bank case just proved that access is not a right. It's a privilege, and privileges can be revoked. Now, let me show you the canaries, the early warning signs that this isn't just about one bank, but about a systemic shift in how financial power operates. Now, let me show you the canaries. The early warning signs that this isn't just about one bank, but about a systemic shift in how financial power operates. Canary number one, the stock price. In 2024 and into 2025, the Canadian banking sector rallied. Royal Bank, Bank of Nova Scotia, BMO, they all climbed. Investors poured money back into Canadian financials, betting on stability, betting on that famous Canadian banking conservatism. But TD lagged. While its peers rose, TD flatlined. The market created what analysts call a valuation gap. And that gap isn't noise. It's not temporary pessimism. It's the market pricing in a simple reality. TD Bank is broken, and it will stay broken for years. How many years? Look at Wells Fargo. In 2018, Wells Fargo was hit with an asset cap after the fake account scandal. That was 7 years ago. 7 years of being locked in a cage, unable to grow, watching JP Morgan and Bank of America devour market share. Wells Fargo is still under that cap today. The restriction hasn't been lifted, the monitor hasn't left, and TD Bank is now walking the same path. 3 to 4 years minimum, if they're lucky. A decade if they're not. Canary number two, the political theater. Senator Elizabeth Warren stood before Congress and called the TD plea deal absurd. She said the corporate death penalty, the complete revocation of TD's banking charter, should have been on the table. Now, whether you agree with Warren's politics or not is irrelevant. What matters is that a sitting US senator publicly stated that the United States had the authority to kill a foreign bank outright, not fine it, not restrict it, kill it. And nobody in the financial media questioned that premise. Nobody asked, wait, can the US actually do that? Because the answer, friends, is yes. Yes, they can. The corporate death penalty is real. It's rare, but it's real. It means the US government revokes your license to operate in dollars. You are excommunicated from the financial system. Your accounts are frozen. Your transactions are blocked. You become a ghost. And for a bank, that is literal death. You cannot be a bank without access to the payment rails, and the payment rails run through New York. So when Warren said TD deserved the death penalty, she wasn't being hyperbolic. She was naming the weapon that the US chose not to use. The asset cap is the compromise. It's life in prison instead of execution. But make no mistake, it's still a cage. Canary number 3, the expansion collapse. TD had a strategy. It was elegant, it was ambitious, and it was expensive. They were going to acquire First Horizon Bank, a regional powerhouse in the American Southeast. That deal would have added 412 branches across the Sun Belt, Florida, Tennessee, North Carolina, Georgia, markets that are exploding with population growth, real estate development, and wealth migration. The D was going to plant a flag in the fastest growing region of the United States and compete directly with the big American banks on their home turf. The deal was worth $13 billion. It was approved by shareholders. It was months away from closing. And then the US regulators stepped in. They didn't formally block it. They didn't have to. They simply asked questions. They raised concerns. They delayed. They made it clear that a bank under investigation for money laundering was not going to be allowed to grow by $13 billion. And so TD walked away. They paid $200 million in breakup fees and slunk back across the border. But it wasn't just First Horizon. TD had plans to open 150 new branches across the US over the next 5 years. Organic growth, brick and mortar, Main Street banking. All of that canceled, shelved, dead, because you cannot open new branches when you're legally prohibited from increasing your asset base. Every new branch, every new loan, every new customer deposit pushes you closer to the cap. So TD is now in retreat, not because they want to be, but because they have no choice. And while TD sits frozen, who's winning? JP Morgan, Bank of America. Wells Fargo, even in its own cage, is still bigger and more entrenched. The American banks are eating TD's lunch in real time, and TD can only watch. This is not competition. This is elimination. Now let me show you the trap, the beautiful, cruel logic of the asset cap, because TD has 3 options, and all 3 options lead to pain. Option 1, they try to grow. They push the limits. They expand their loan book, attract more deposits, chase revenue. And the moment they cross $434 billion, they trigger the death penalty clause. The US government will not hesitate. They've made that clear. Cross the line and the charter gets pulled. The bank dies. Option 2, they shrink. They sell off assets, close branches, lay off employees, reduce their footprint. This keeps them under the cap, but it also guts their revenue. Shareholders flee. The stock price collapses further. Credit rating agencies downgrade them. They enter a death spiral, not because they're insolvent, but because they're starving themselves to comply with US orders. Option 3, they stay perfectly still. They manage their balance sheet down to the penny, never exceeding the cap, never shrinking too much. They become a zombie bank, alive but not really, profitable but not growing, relevant but not competitive. They exist in stasis, waiting for the US government to decide they've been punished enough. That's the trap, that's the cage. And there is no 4th option. There is no escape hatch. TD Bank is now a case study in what happens when you operate in someone else's currency and you break their rules. You don't get a fair trial. You don't get due process. You get a plea deal and a cage, and you thank them for not killing you outright. Now, I know what some of you are thinking. You're thinking, but they deserved it. They laundered money for drug cartels. They enabled fentanyl trafficking. They turned a blind eye to crime. And you're right, they did. The evidence is overwhelming. Uncle David and his trash bags are real. The $470 million in cartel cash is real. The 92% failure rate on transaction monitoring is real. But here's the question you should be asking. Why did the Canadian government let it slide? Why did FinTrack, the agency specifically tasked with preventing this exact type of crime, fine them $9 million? That's not accountability. That's a participation trophy. That's a wink and a nod. And the reason is simple. TD Bank is a pillar of the Canadian economy. It's the second largest bank in the country. It employs tens of thousands of Canadians. It finances mortgages, small businesses, infrastructure projects. Killing TD Bank would send shockwaves through the entire Canadian financial system. So Ottawa looked the other way. They issued a symbolic fine and hoped the problem would fade. But Washington didn't look away. Washington saw an opportunity to demonstrate power, an opportunity to send a message. And the message was this: if you want to play in dollars, you play by our rules, not yours. We don't care what your domestic regulators say. We don't care about your sovereignty. The dollar is ours, and the dollar is the weapon. This is what I call extraterritorial reach. The United States government claiming jurisdiction over crimes that happened in Canada committed by a Canadian bank under Canadian law. And they can do this because every transaction that touches a dollar touches American soil. When TD processed Uncle David's deposits, that money moved through correspondent banks in New York. It cleared through the Federal Reserve System. It interacted with US infrastructure. And that interaction, that brief digital handshake with American systems, gave the US government the legal hook to prosecute a foreign entity under American law. Now think about the implications. Every bank in the world that operates in dollars is subject to this same logic. Deutsche Bank in Germany, HSBC in the UK, Mitsubishi UFJ in Japan. If they touch dollars, they touch America. And if they touch America, they can be prosecuted by America. This isn't conspiracy. This is stated policy. This is how the US enforces sanctions against Iran, against Russia, against North Korea. They don't invade. They don't bomb. They simply cut you off from the dollar system and you collapse from within. The TD Bank case is the domestication of that weapon. It's the US government showing its allies, not its enemies, its allies, that the same rules apply. Canada is not exempt. Europe is not exempt. No one is exempt. And if you think your money is safe because it's in a foreign bank, think again. That foreign bank is only as sovereign as the US government allows it to be. Let me take you deeper into the mechanism. Let me show you how the rot spreads. Because TD Bank isn't an isolated case, it's a symptom. In 2012, HSBC was caught laundering money for Mexican drug cartels and violating sanctions against Iran. The evidence was so damning that the US Senate called it pervasive and willful. HSBC paid $1.9 billion in fines, accepted a 5-year deferred prosecution agreement, and installed a monitor. But they didn't get an asset cap. They were allowed to keep growing. In 2018, Wells Fargo was caught creating millions of fake accounts to meet sales targets. They defrauded their own customers, destroyed credit scores, and charged fees for services that didn't exist. Wells Fargo paid billions in fines and got the asset cap. They're still under it. In 2023, Binance, the world's largest cryptocurrency exchange, pleaded guilty to money laundering violations. They paid $4.3 billion, the largest corporate fine in US history. Their CEO went to prison. But Binance is still operating. Now TD Bank in 2024, $3 billion in fines, a guilty plea, an asset cap, and a monitor embedded in their boardroom. The punishment is escalating. The US government is tightening the noose, not loosening it. And the pattern is clear. The closer you are to the dollar system, the harsher the penalty. HSBC is British, but it's globalized. Wells Fargo is American, so it got the cap. TD is Canadian, right next door, deeply integrated into the US economy, and they got the cap plus the monitor plus the public humiliation. This is the convergence. This is the trifecta I want you to see. Three forces hitting at the same time. Force number one, systemic greed. TD wasn't a rogue bank. It was a growth-obsessed institution that prioritized revenue over compliance. They saw the warning signs. Internal audits flagged the problems. Whistleblowers raised alarms, and management ignored them because fixing the problem would have cost money and slowed growth. The machine demanded growth, so they fed it, even if it meant breaking the law. Force number two, the fentanyl crisis. This gave the US government a moral justification. Fentanyl is killing 100,000 Americans per year. It's a national emergency. It's a political third rail. When the DOJ can stand up and say, this bank enabled the fentanyl trade, no one pushes back. No one defends the bank. The public outrage is automatic, and that outrage gives the government cover to do what it wanted to do anyway: tighten control over foreign banks operating in dollars. Force number three, extraterritorial reach. The legal architecture that allows the US to prosecute foreign entities for crimes committed abroad. This isn't new. It's been used for decades in sanctions enforcement, but it's accelerating. The US is expanding the definition of what counts as American jurisdiction, and every bank in the world is scrambling to keep up. These three forces converged on TD Bank in 2024, and the result was total capitulation. A foreign bank operating under foreign laws was brought to its knees by the United States government, and the precedent is now set. Friends, I want you to think about what this means for you, not in abstract terms, but in concrete, practical terms. If you have money in a bank, any bank, that money is not as safe as you think it is, because your bank is subject to rules and forces that you don't control and can't predict. Friends, I want you to think about what this means for you, not in abstract terms, but in concrete, practical terms. If you have money in a bank, any bank, that money is not as safe as you think it is, because your bank is subject to rules and forces that you don't control and can't predict. Let me explain what I mean. When TD Bank hit the asset cap, what happened to their customers? Nothing immediate. The deposits didn't vanish, the checking accounts still worked, the ATMs still dispensed cash. But beneath the surface, something fundamental changed. TD became a less attractive bank. They couldn't offer the same competitive rates. They couldn't expand services. They couldn't innovate. And slowly, quietly, the smart money started leaving. This is what I call the liquidity erosion. It doesn't happen overnight. It happens in slow motion. A wealthy client moves their accounts to JP Morgan because they want a bank that's growing, not shrinking. A business owner refinances with Bank of America because TD can't offer the same loan terms anymore. An investor sells their TD stock and buys Royal Bank instead. None of these decisions individually matter, but collectively they create a cascade, a slow motion bank run that happens not in days, but in years. And here's the psychological component you need to understand: normalcy bias. Human beings are hardwired to believe that tomorrow will look like yesterday. Your money was safe in the bank yesterday, so it will be safe tomorrow. The system worked last year, so it will work next year. This cognitive shortcut keeps us sane, but it also keeps us blind because systems don't fail gradually. They fail suddenly after long periods of hidden stress. TD Bank looked perfectly fine on the surface for years, while $18 trillion in unmonitored transactions flowed through their pipes. The facade was immaculate. The stock price was stable. The quarterly earnings beat expectations. And then, in a single moment, October 2024, the facade cracked, and everyone saw the rot underneath. The bank didn't fail because of some external shock. It failed because it was hollow inside, and finally, someone checked. Now, apply that logic to the broader system. How many other banks are running the same playbook? How many other institutions are prioritizing growth over compliance, chasing quarterly targets over long-term stability? We don't know. We can't know. Until the US government decides to look, until the regulators decide to crack open the books, the facade holds. But the TD case proves that the facade is exactly that, a facade. Let me introduce you to another concept, the money illusion. This is the idea that you can become wealthier on paper while becoming poorer in reality. TD Bank's shareholders experienced this firsthand. From 2018 to 2023, TD's stock price climbed. The bank reported record profits. Analysts upgraded their ratings. On paper, if you owned TD stock, you were getting richer. But that wealth was built on a foundation of fraud. It was built on unmonitored transactions and willful blindness. And when the foundation cracked, the paper wealth evaporated. This is the trap of modern finance. You think you own assets, but what you really own are claims on assets. You don't own the bank, you own shares in the bank. You don't own the gold, you own an ETF that promises to track the price of gold. You don't own the property, you own a mortgage-backed security that represents a slice of someone else's debt. And when the system comes under stress, when the TD banks of the world get asset capped, when the dollar weapon gets deployed, those claims become worth less than you thought. Sometimes they become worth nothing at all. So let me ask you the question that matters. Do you own assets or do you own claims on assets? Because that distinction is about to become the most important financial decision of your life. Now, I want to talk about the elephant in the room, the thing nobody in the financial media will say out loud. The TD Bank case isn't about justice. It's about power. It's about the United States government demonstrating that it can reach across borders and destroy institutions that don't comply. And the reason they can do this, the only reason, is because of the dollar. The US dollar is not just a currency. It's the global reserve currency. 70% of international trade is denominated in dollars. 60% of global foreign exchange reserves are held in dollars. Every central bank, every commercial bank, every corporation that operates internationally holds dollars and transacts in dollars. This gives the United States an asymmetric power that no other nation possesses. When the US imposes sanctions, when the US fines a bank, when the US cuts off access to the dollar system, it's not just a national action, it's a global action because the dollar is global. And that power is now being weaponized at an accelerating rate. Look at Russia after the invasion of Ukraine. The US and its allies froze $300 billion in Russian central bank reserves. $300 billion. That's not a sanction. That's confiscation. That's the United States government reaching into the vaults of a foreign central bank and taking their money. And they could do it because those reserves were held in dollars in accounts that ultimately clear through New York. Now look at TD Bank. The US government didn't freeze their assets, but they might as well have. By imposing the asset cap, they froze TD's ability to grow, which is the same as freezing their future. And they did it not because TD threatened American national security, but because TD broke American laws while operating in American currency. The message is clear. The dollar is not neutral. The dollar is a tool of American power. And if you operate in dollars, you are subject to American authority, regardless of where you are or what flag you salute. This brings me to the psychological pivot, the shift you need to make in your own mind. You need to stop thinking about money as a neutral medium of exchange and start thinking about it as a political instrument. Your dollars, your bank account, your stocks, your bonds, they are all embedded in a system that is controlled by a single government, and that government is increasingly willing to use that control to achieve its objectives. Now, what are those objectives? In the case of TD Bank, the stated objective was to punish money laundering and combat the fentanyl crisis. Noble goals. But the unstated objective, the one that matters, was to demonstrate dominance, to show Canada and every other American ally that Washington is in charge, that the financial system is not a cooperative arrangement between sovereign nations. It's a hierarchy, and the United States sits at the top. This is the new reality. And if you're not adjusting your thinking, if you're not adjusting your behavior, you are setting yourself up for a very painful awakening. So what do? What's the action? Because I'm not here just to scare you. I'm here to prepare you. First, you need to understand the binary choice. On one side, you have claims on assets, stocks, bonds, ETFs, bank deposits. These are pieces of paper, or more accurately, digital entries in a database that promise you something. They promise you dividends, interest payments, access to your money, but promises can be broken. TD Bank shareholders were promised growth. They got an asset cap. Russian oligarchs were promised access to their reserves. They got frozen accounts. On the other side, you have direct ownership of real assets, physical gold, physical silver, real estate that you hold the deed to, commodities that you can touch. These assets exist outside the banking system. They can't be frozen by a regulator. They can't be capped by a government agency. They are yours completely and totally in a way that a stock certificate or a bank balance can never be. Now, I'm not saying you should liquidate everything and buy gold bars. That's not practical for most people, and it's not what I'm advocating. What I am saying is that you need to diversify your risk. You need to own some assets that exist outside the system because the system is under stress, and that stress is going to increase. The TD Bank case is a warning shot. It's the US government showing its hand, demonstrating what it can do when it wants to. And if they can do it to a Canadian bank, a bank from a country that is America's closest ally, most integrated trading partner, and geographic neighbor, they can do it to anyone. Let me give you the specific mechanism for why gold and silver matter in this context. When a bank gets asset capped, when a currency gets weaponized, when the system comes under pressure, people flee to safety. And the oldest, most reliable form of safety is precious metals. Not because gold pays dividends, not because silver generates cash flow, but because gold and silver are no one's liability. They don't depend on a government's promise. They don't depend on a bank's solvency. They exist. They have weight. They have value that has been recognized for thousands of years across every culture, under every political system. This is not an investment thesis. This is a survival thesis. When the TD banks of the world are locked in cages, when the dollar weapon is being deployed against allies, when the financial system is revealing itself to be not a cooperative network, but a tool of imperial power, you need to have a portion of your wealth outside that system, not all of it, but some of it, enough that if the cage comes for your bank next, you have options. Now, let me bring this full circle. Let me show you how the TD Bank story connects to the larger narrative that we've been tracking for years. The global financial system is undergoing a phase change. It's moving from a period of cooperation and expansion to a period of competition and contraction. The rules that governed finance for the past 70 years, the Bretton Woods system, the petrodollar, the Washington consensus, are breaking down. And in their place, we're seeing the emergence of something more primitive and more dangerous: raw power. The US government is using the dollar as a weapon because it can, because it still has that power. But every time it uses that weapon, it degrades the legitimacy of the system. Every time it freezes a foreign bank's assets, every time it imposes an asset cap on an allied institution, it sends a message to the rest of the world. The dollar is not safe. The dollar is not neutral. If you hold dollars, if you operate in dollars, you are subject to American political whims. And slowly, quietly, the rest of the world is responding. China is building alternative payment systems. Russia is demanding payment for energy in rubles or gold. The BRICS nations are discussing a commodity-backed currency. These efforts are still in their infancy and they may fail, but the fact that they're happening at all is significant. It means the world is trying to escape the dollar system, and the reason they're trying to escape is because of cases like TD Bank. When you weaponize your currency, you undermine its value, not immediately, not in the short term, but over time, trust erodes, and currency is built on trust. The dollar is strong not because of American gold reserves or American GDP, but because the world trusts that a dollar will be worth a dollar tomorrow. When that trust breaks, when people start to believe that their dollars can be frozen, confiscated, or rendered worthless by political decree, the entire system begins to unravel. We're not there yet. The dollar is still dominant. The US financial system is still the most powerful in the world. But we are watching the early stages of that unraveling, and the TD Bank case is one of the threads being pulled. So here's my final message to you, friends. History favors the prepared, the people who see the structural faults before they become catastrophic failures, the people who understand that the system is not permanent, that the rules can change, that the institutions we trust can betray us or be destroyed. The D-Bank thought they were too big to fail. They thought their Canadian charter would protect them. They thought compliance was optional if growth was strong. They were wrong on all counts. Don't make the same mistake with your own wealth. Don't assume that your bank is safe because it's always been safe. Don't assume that your dollars are secure because they've always been secure. Don't assume that the system will continue to function the way it has because that's the way it's always functioned. The window for preparation is closing. Not tomorrow, not next week, but it's closing. The TD Bank case happened in October 2024. And we're living through the fallout in 2025. How many more cases like this will there be? How many more banks will get capped, monitored, or destroyed before the broader public wakes up? We don't know, but we know it's coming. So ask yourself the question: when the asset cap comes for your bank, when the liquidity drains, when the system reveals itself to be hollow, will you be ready? Will you have diversified into real assets? Will you have stepped outside the line of fire? Or will you be another casualty of normalcy bias, another person who saw the warning signs and did nothing? The choice is yours, friends, but the time to choose is now. Thank you for being here today. And remember, in a world where banks can be caged and currencies can be weaponized, the only real security is the security you build yourself.